Hi guys, my name is Omar, and today I'm going to be teaching you guys what liquidity is to me, right? What liquidity is and how it works. So, what is liquidity? Liquidity is built up by a lot of things. Some key points of liquidity is some things that build liquidity is one, stop losses and TPs or take profits. That's a form of liquidity. Um, Two is key market levels such as previous session highs and previous session lows. We have three order blocks or institution orders. So we have massive orders that have not got filled in yet. So price actions naturally come want to fill those orders in. And four, how liquidity gets made is slippage. And what I mean by that is not all orders get filled in. So price is naturally, or institutions want to fill these orders in. So they come to take where price is to take out those orders. And what I mean by that is not all orders get filled in. And this is actually very important. This is the main key topic, like key topic to liquidity. So example right here. Someone, oops, someone placed an order right here at the PM low, where this could be the New York session low. This order might have not got filled in, so price naturally might come down and take it out. But this is just a theory. This is just a theory. This is how I think liquidity works. And now I'm gonna explain to you guys a form how liquidity works or how I do liquidity. So number one, stop losses and TPs. Okay, so let me explain this to you. So let's say you place an order, and this is NQ100, right? This is Nasdaq. So you apply two lots right here. So, okay, whenever this order gets filled in. So this would be a form of resting order. We're gonna do TP right there. Yeah, sure. TP right here. A small little take profit of 20 points. You're gonna risk, let's say, this low right here. Like 1 to 2 reward. Or, oops, an SL right here. So what you just did right there is you just set two orders, a form of liquidity. Wow, price is bumping. Probably, how do I fill in this order? Let's just buy a market. Okay, there you go. Put like this. So right there and right there is a form of liquidity. So what you just done is you created liquidity resting at this high right here, and liquidity resting at these lower here. So we used it. You just created some form of liquidity. Now we have four ticks. Obviously, this isn't my trading model, but I'm just explaining to you guys a form of liquidity. So liquidity is just resting orders. So that's just form of liquidity, right? So take profit and stop losses. These were orders are resting, and prices to come and fill these orders in. We have number two, market levels. And it's gonna be previous session highs and previous session lows, and current session highs and current session lows. Now, why are these? What is it? Markets. Why are these key levels? All right. So let's go through here, right? Okay. So this is the New York high right here, or we're gonna call this the New York AM high. So at the peak of the trading of the New York AM session, someone left orders right here. Institution, it could have been institution, somebody who's not a big trader, a retail trader, could have left an order that did not get filled in, and this is due to slippage. So someone left an order right here that didn't get left into slippage. So price naturally later throughout the day or later might come and take it out, and and then might take out the pool of liquidity, and then it'll say it wants to dump out again, then it'll do what it wants. And that's just how it works. So that could be session highs, session lows. And not all orders get filled in. Not every single order will get filled in. So how to put it like this. Uh Here's a session low. Let's get back in time. So here, 30 minute. Let's go okay, right here. Okay. So this is a New York session. This is a New York session, right? So right here, this was the New York low. So this is the New York low. So price or opened up during the Asia session, came, dumped down, and naturally came back up and took out this session low. Because here there was resting orders, so price wanted to take out these orders, and then it consolidated, and then price wanted to do what it wanted to do. But that's just how a form of liquidity works. So let's go to another example. This is just what price naturally does. So here we have a perfect example, right? Actually, not so perfect, but kind of perfect. So here we have from London session, right? This is a London session, right? London session left the session, kind of the session high right here, right? And this is before the big sell-off. So there was definitely order stressing here. So price, not all sell orders got filled in. So price came down, wick, down, let's say 400 points, right? So price came down all the way down, all the way down, all the way down, and then pumped back up during New York PM session, so during Asia, then back in London session again. Price came out and took out these sell orders right here, and it took them out by this little wick right here. As you can see right here, price came and took out that session high and that session low because there was orders resting right there. So price naturally came, swept them, and then we have the real move. Then we had this, guess that's the manipulation leg, took out those orders, and then we had the move again, dump again. Two very similar sessions. All right, now that's just a session high. Now this could work with session lows too. So just naturally, like here we go. We have this Asian low right here. This is an Asia low. Okay, so this is the Tokyo session. So Tokyo pumps up the market. London just kind of stalls it out a little bit, and then New York session, they go sweep that liquidity, and they actually sweep a lot of liquidity all the way towards down here. They sweep like wow, like 100 points towards downside. That's crazy. And then they go back up again because they just came to took out the resting orders that was right there. Obviously, this is kind of like an extreme example because naturally price doesn't really do this, but it's an example. If we go back to other scenarios, let's say we go back in time. We have, let's say, okay, right here. We have a session low here. So we're here. London left this, Asia left the session low. So London comes, takes it out, and go pumps back up again. And that's just how it is. So I hope that I could give you an example of that. That's how it is. And the reason why this happens is because banks leave their orders right there, or so they click buy. Now all orders can get filled in because there's not enough liquidity. And what I mean by that, there's not enough. Example: someone leaves 10 buy orders on 10 buy orders right here, right? But there could only like there's only 5 sell orders, so something much smaller. So at the end, there's gonna be 5 still remaining orders at that price. So not all orders can get filled in, and that could also be kind of a form of slippage. Okay, so I hope you guys could understand that. Anyways, to the next point. 3. Okay, so order blocks or institution orders. So how I think about it, I'm not sure if I'm right. So if someone could correct, if someone knows, feel free to correct me. Banks only care about one thing when they're going longs. Let's say they're going longs, is how cheap can they buy the price? How cheap can they buy the asset, the commodity they're trading? So here we have Nasdaq 100. So we have order blocks, right? So let's say a bank wants to buy a price. Let's say they want to buy NQ at this price range right here, right? So they wanted to buy here, right? Well, here they're gonna stack up, so they're gonna limit like let's say 1,000 buy orders, and price is naturally gonna come. The other institutions see this, and price is naturally gonna come here, and then it's gonna go pump up again. Obviously, this is just a small little example, but there could be a lot of resting orders at a certain place. One way to know that is how do I put it? Okay, remember when I said session lows and session highs again? It's if price reacts heavily off a session high or a session low. I have to find an example of this since I don't have one top of my head, but if you were to do, let's say, so you got this like pool liquidity, right? So if you were to do this right here, okay, price comes here, touches it, and then instantly rejects off 100 points. Obviously, this isn't high. This is on a high time frame, but just a small example of what is it if of what is it institution orders or someone left a big order. You could also do this by looking at the book map, but I don't have access to the book map, so unfortunately I cannot show you guys that. Anyways, and then last thing is slippage. So I pretty much explained it. Let's say we're trading at, say this example 887. Let's mark at this level 887 right here. Great, okay, we're 935. Let's say there's 20 sell orders at 995, but there's only 10 buy orders. So what's gonna happen is all these 10 orders are gonna get filled in, but we're still gonna have 10 sell orders giving you slippage. And now orders get filled in, so this is gonna shrink down. Well, all this gets taken out, and you're still gonna have this much sell orders, 5 sell orders, 10 sell orders resting at this price. And yeah, that was basically liquidity in a super easy way. But now I'm gonna dive down a little deeper and show you guys what price does off this liquidity. So let's get to that. Let's go to the 5-minute and show you guys how price usually reacts off liquidity, or how usually it moves. So perfect example right here. You have New York PM session right here. So New York PM session or New York lunch session leaves some lows right here, right? So these are some where some orders got left at. Okay, so what's on this lunch session right here, right? And this is just computer trading, but they still left orders right there, right? So price, PM session, dumps. Then here we started the Sydney session, and price comes and sweep these lows right here, sweeps them. So it takes out the liquidity right there, and then we have a pump towards the upside. Then we start pumping towards the upside. We can see that very clearly here. And then it grabs the liquidity, and then it sweeps where, then it goes where price actually wants to go. Um, and that's how, that's basically it. So let's say example, if you're trading a reversal model, you could let's say you join off here, then you can aim for price another pool of liquidity, which would be right here, which would be this high right here, and you would easily hit TP for 119 points if you trade the Asia session of the Nasdaq. But that's kind of crazy. Oops, what did I just do? Okay, so another example, let's say something like let's say something there during the PM session. Okay, something like, how do I, where's a good trade? What's a good trade? Okay, something like this, right? Okay, so we took out some lows and we swept liquidity from right here, right? So here we swept some liquidity right here. We obviously couldn't sweep the whole move, but this is a little like, what, like 34 points. I remember trading this day. Okay, so here we sweep these lows, right? We sweep these lows. So we took out any orders that were resting right here. We took them out. Cool. Now what's gonna happen next? Let's say you're trading a reversal model. You could just trade and to the nearest pool of liquidity, which would be these two equal highs around right here. And you could just aim that right there. That's a pool of liquidity. And boom, 114 points on the Nasdaq. You know, that's like what, like 2 grand if you're trading a single lot of what is it, one single contract, one single mini. But yeah, that's pretty simple. There's other examples I could go over. Like this is the 5 minutes. So let's say Asia session. We have a New York session right here. Let's say you're trading a continuation model. So let's say you joined. This is an actual trade I took. I think on top like this. Okay, right here. This is why I took the trade, right? So no, okay. So this is a trade I took, right? So I top took right here to a standard deviation level, and I aimed it for a pool of liquidity. Okay, one pool of liquidity I saw was this resting Asia high right here. So remember when I said some orders got filled left in right there? I didn't get fully taken out because remember not all price doesn't come and sweep all orders at once. So I left it right here, this Asia high. I didn't see it, and then we can see that price comes immediately, takes out my order, and rejects up because there was definitely orders resting right there. And yeah, that was an easy trade. Or you could, for example, if you were, let's say you trade a continuation model instead of reversal model, let's say you join off this fair value gap, I don't know, like right here, I don't know, oops. So you're joining shorts right here, okay? Well, let's say you don't want to target this pool of liquidity, you want to target something a little lower. So you look to your left, okay, you're like, okay, well, there's some liquidity resting right here, there's some liquidity resting right here, and there's definitely liquidity resting right here. Well, if you want to, be a big boss man and trade the whole move down on paper, or not on paper, like, theoretically, you could have traded the whole move down and you would have actually banked perfectly. Like, this would have been a perfect trade. And you see how price comes, takes this order, sweeps the liquidity down here, and instantly rejects. That would be where an institution have an order, have orders resting, and you could tell that because this is an Asia low, and then price instantly comes, takes, keeps going up. And yeah, that's about it. There's nothing much more to liquidity, just where equal highs, equal lows rest, where just a bunch of liquidity comes and price usually comes and takes those out. And yeah, that's basically it about liquidity. Liquidity is just where a bunch of orders were left, unfilled orders were left, so price naturally comes and takes those out and gets that liquidity and decides where it wants to go next. You can either trade to liquidity or you can trade off liquidity. Once a continuation model for the to liquidity, and when, if you're trading off liquidity, that would be a reversal model. But yeah, liquidity is a super super simple concept. And yeah, you also have to figure out what's the right pools of liquidity. Example, um, let's say price. Let's go to a 4 hour. Right? Let's go to the 1 hour candle. Right. Let's go 1 hour candles. Uh, let's say I was gonna trade reversals off this, right? I was gonna trade reversals. Let's say I wanted to top tick this or whatever, or I wanted to trade reversal off that, right? So if price would come and take out this 1 hour high, but it didn't take out the session high, I probably would not trade this because this is external liquidity and there's a higher chance of this liquidity being here than down here. So yeah, guys, that's about it for liquidity. Let me know if you have any questions or anything of that nature. But it's super simple. And yeah, that's about it. Look, you can see right here, some perfect example of liquidity. Our price sweeps right here, goes back up again, sweeps again, goes back up again. All right, so super simple, guys. Super simple stuff. Let me know if you have any questions. Um, Feel free to ask me anything. Yeah, that's about it. My name is Omar or Ropario.
No, I can't laugh yet. I've got to hold it in. They're all gonna die.